aspects of it. One of the key application of blockchain has been on the DeFi phase or the decentralized finance phase is how you trade, how you exchange your currencies, right? Because a lot of cryptocurrencies has happened. A lot of cryptocurrencies after Bitcoin, Ethereum got a good valuation, and obviously the valuations keeps fluctuating. So then, like a lot of kind of people started thinking about generating their own cryptocurrencies, right? And some of them have been also successful. So now the question came, can we exchange it? Can we like exchange those cryptocurrencies? Can we buy and sell that, right? So that is where the exchanges came into place. Then exchanges were of two types, centralized exchanges and decentralized exchanges. Centralized means there will be like third party, right? Entity like, and till now also, I think most of the exchanges, if you see, whenever if some of you are into this cryptocurrency investing or trading, right? You might participate in Binance or Coin Exchange, all those exchanges, right? Most of them are actually centralized because what happens whenever you are, uh, so there is a, let's say I want to sell, I have certain, let's say Polkadot or some kind of cryptocurrencies, I want to sell that, right? So what will happen in the somewhere in the other part of the world, somebody wants to buy it, right? Normally, like in your stock exchanges, how it happens. Let's say I have NTPC or Tata Power or whatever Tata Motors share, and I want to sell at a certain price, and some of or like other some other person need to buy it, right, at a certain price. So that is how those exchanges order book is managed, right? Some traders or some investor want to sell, and some investors or some traders want to buy, right? I want to sell at certain price, somebody else want to buy it at a certain price, and that is how the matching happens. And overall, depending upon the supply and demand, right, your kind of price movement happens. If a supply of a lot of kind of many people want to sell certain stocks, right, in a particular day, then obviously the prices will come down. But if many persons, many traders, many investors want to buy a certain stock at a certain day, obviously the price will go up. Same situation here also in cryptocurrency. It keeps fluctuating, right? If I want to, like many people want to buy BTC or Ethereum, right? Prices will go up. If the demand is low, then prices will come down, right? So that is how, like normal exchanges, if you are exchanging your stocks, I want to sell some of my stocks and buy something, right? I keep doing that in my normal, yeah, either NSE or BSE, right? Same thing. So those are also centralized exchanges. There I trade my stocks. Same thing, I can trade my cryptocurrencies in different centralized exchanges, right? Then the concept came up, decentralized exchanges rather than third party one. So the problem what happens in centralized exchanges, whenever you are giving the money or the cryptocurrency, actually they are storing that cryptocurrency on your behalf, right? So for that part of time, whether single 1 day, 1 year, or few months, actually that exchange is holding your cryptocurrency, right, in the centralized exchanges. Same thing with your trader, right? Demat, wherever you have your demat account, you create account and you store that whatever your stocks, mutual funds, whatever you have assets, you store there. Same concept here in the centralized exchange. But when the concept of decentralized exchanges came, so now the point came is that okay, we won't keep a order book. So we won't have that okay, somebody wants to sell this and somebody wants to buy it, and we'll have to like match them. So that concept won't be there. We'll keep it completely automated. So the market will be made. So this is something known as when that kind of uh, breeze happens, right? Somebody wants to sell, somebody wants to buy, right? So that is the term known as in stock exchanges. Somebody is making the market, and that is the role that Bombay Stock Exchange and National Stock Exchange play. In this particular case, decentralized exchange, that is played by that algorithm. So now what will tell? Okay, we'll not make one-to-one kind of peer-to-peer, person-to-person kind of transaction, right? So it will be basically we'll keep a pool. So that is where the liquidity pool concept came. Okay, so we'll create a pool. People, no matter what, will store their in a certain ratio. They have to put their money to be part of that liquidity pool. They are known as liquidity providers, and there will be people who wants to trade in the cryptocurrencies, right? If they want to take money or if they want to give money, give certain cryptocurrencies, they have to maintain certain ratios, right? And that ratio will be done by, or that ratio will be determined by the automated market maker, right? So I have discussed this slide, but I think last class some of you had questions. So let us try to understand through an example. I'll come back to this slide. Let me open Excel file and try to explain it through that. So again, we are going to discuss only one of the like simplest concept. There are different automated market maker or AMM kind of algorithms. Okay, so how does it work? So they will create a liquidity pool. Okay, so we'll take a simple example of our uh, let's say what is that, Ethereum or something, right? Ethereum and let's say INR. Okay, so let's say I want to create this liquidity pool. Okay, so Ethereum and INR. So the pool means combination of two cryptocurrencies, right? So there is a protocol, or there is a decentralized exchange which is kind of most famous is Uniswap. So what they will tell, the condition is, if you want to create a liquidity pool of something, let's say it is actually they will not create for INR. Let's say RBI has created a central bank digital currency. So let's say this is RINR, right? So this is, let's say, cryptocurrency which is created by, as of now they have not created, but they are going to create in future. So let's say this is there. This is a cryptocurrency RINR, hypothetical cryptocurrency, and ETH. Okay, ETH is Ethereum. That is also a cryptocurrency. So now the concept is, in Uniswap's case, if you want to create a liquidity pool, the ratio will be 50-50, right? The value of the ETH, what we are going to keep there, and the INR, right, has to be same, right? So that is the 50-50 ratio. So now what happens if I go to market and look into current market price of one Ethereum, right? It is around 3 lakhs, or I think 3.5 lakhs. Recently, I have not seen that. Okay, so let's say this is 3. Okay, so now what will happen? Let's say, and they will also say that, okay, how much investment, minimum investment is required to create a liquidity pool. Okay, so now let's say they have told that, okay, at least you have to keep around 35 lakhs. Okay, again, I'm giving an example. It varies from different pool to different pool. So 35 lakhs means equally it will be divided. So I'll have 10 Ethereum and 35 lakh. So this is a, I'm like writing it as RINR. So this is a hypothetical currency. Let's say RBI comes with their own digital cryptocurrency, right? So now what will happen? This liquidity pool, okay, is created with Ethereum, 10 Ethereums and RINR. So this is 35 lakhs. Hopefully I have all the zeros. Okay. Now what happens? This is also a cryptocurrency and this is also a cryptocurrency, right? So this is the liquidity pool which let's say I have created, and some of you, let's say, are the traders, cryptocurrency traders, right? And you saw the arbitrage opportunity. Arbitrage, I think most of you hopefully understand. Arbitrage means whenever there is a difference in currency rate or any asset difference, right? So there is arbitrage. Let's say oil prices, right? A lot of people do arbitration in arbitrage, take the arbitrage opportunity in oil commodity market. Let's say certain oil prices are at a certain exchange is less, so they'll buy from there and sell it at a other exchange where the oil prices are more, right? So that is the oil arbitrage. Same situation here. So in Uniswap, let's say there is a liquidity pool of Ethereum and RINR. and I have 10 Ethereum and 35 lakh of RINR, right? Now what happens in the market? Every day Ethereum value is fluctuating. Some day it will be low, some day it is more. So what does Uniswap's rule says? The product of number of Ethereum coins and whatever other cryptocurrency in that liquidity pool has to be maintained. So what is the product? 10 multiplied by, so around 3.5 crore, right? So this is a simple rule of x multiplied by y is equal to k. So these product, the algorithm is very simple, constant product algorithm. That means the product of those two crypto asset, number of crypto asset in that liquidity pool need to be remain constant. So this is 3.5 crore. So now what happens? You are a trader, like one of you is a trader, and he is in Binance. Binance is a centralized exchange. Okay, so let's say you have account in Binance or WazirX or CoinDCX, wherever you have, right? And you found out that now Ethereum prices has come to, let's say, 4 lakhs. Obviously, that much difference won't be there. Before that, people have already have taken care of that. But let's say suddenly you saw today you logged in into that portal and saw that Ethereum is running at 4 lakh. Price of Ethereum is 4 lakh. So now what will happen? Now you know that in this Uniswap exchange, Ethereum pool, there is Ethereum and RINR pool, which is around RINR is around 3, how much? 3,50,000, right? So now what will say? I will buy Ethereum from here. I'll take Ethereum from here and sell it at Binance, right? So that is the arbitrage opportunity, right? So there will be many traders who will like to take that opportunity. So let's say as a trader, what will tell? Let me buy one Ethereum. Okay. One Ethereum from here. I have some money. So one person bought it. So you have, let's say, 3,50,000. So what will say? So I'll buy now one Ethereum, right? So how much Ethereum is left? 9, right? So the rule is the product has to remain same, right? So that means how much RINR need to be there? This divided by 9. Okay. So that means somebody has to, like, if you want to buy one Ethereum from here, so this much, how much? 3,88,888 or 889, right? This much RINR you have to deposit. Okay. So you got this RINR is basically same as Indian rupees value, right? So what will do? You will deposit. You have 3,88,000 or 3,90,000. You will deposit here in this pool, and you will take one Ethereum. And here the price is 4 lakhs. You will sell it. You will sell it for 1 lakh, like 4 lakhs, and you will, how much profit you will get? 4 lakh minus 3,88,000. Around in a single within 5 minutes or whatever, within few seconds, you will get a profit of 11,111 rupees, right? So this is how the arbitrage opportunity comes, and lot of cryptocurrency traders try to, like, obviously they do not like manually check, so they also will be running algorithms which will be checking at different exchanges, and automatically buy sell things happen. But this is how the simply, like, very simply if I explain, it works. Somebody will, and this is how your constant product mechanism works. So once your one in that pool I have Ethereum and RINR, one thing is decreasing, other part has to kind of other currency has to increase, right? Suddenly if you see in this pool, now the exchange rate, what has happened? Earlier what used to be there, say 3,50,000. Now the exchange rate has happened 3,88,000, right? So this is where the arbitration or arbitrage opportunity comes. Anybody having any doubt on this?
Sir, how is it coming 3,88, whatever the amount, the when you taking the one Ethereum, that is
Hmm.
9, and after that RINR is coming 3 lakh 38 lakh. So how is it come?
Hmm.
Can you please?
So the rule is the product X multiplied by Y is equal to K. This is what like this is the like fundamental logic is the product of both the cryptocurrency need to be constant.
Should be same.
Should
Yes.
be same. Yeah. So when I multiplied, I have initially 10 Ethereum at 3 lakh 50,000 RINR, not 3 lakh 50,000, 35 lakhs RINR. So if I multiply, it is
35 lakh.
3.5 crore, right? 10, this is
Yes.
35 lakhs, 3.5 crore. So once somebody is taking one Ethereum, right? He has to so deposit 3 lakh, not 3 lakh, 38 lakh 88,000, not 38 lakh. How much difference is coming? By he has to basically deposit this much 38 lakhs 3 lakh 88,888. This much money he has to deposit in
Okay.
the exchange. So it is a liquidity pool, right? So it is not that I only will buy. If I want to buy Ethereum, I have to deposit certain kind of whatever that other cryptocurrency I have to deposit. And how much I have to deposit, that will be determined by the product. So if I want to take one Ethereum, I have to deposit how much? 3 lakh 88,000, 38 lakhs. Should be 38 lakhs, right? I've done correct amount.
Eight, eight.
Yes. So this is 38 lakhs 88,000. This is 35 lakhs. So you have to deposit around how much? 38 lakhs 889. No, 38 lakhs. 3 lakhs 88,000. So to take one Ethereum, you have to deposit around 3 lakh 88,889 RINR. RINR, think it as INR. Think it as a Reserve Bank has put a cryptocurrency which has the same value as INR, right? So if let's say you want to trade, right, and you saw the opportunity that in Binance one Ethereum is 4 lakh, right, and in the this pool, right, Ethereum is around 3 lakh 50,000, right? But see how the change happens. You currently the Ethereum value is 3 lakh 50,000, but if I'm taking one Ethereum out, I have to deposit 3 lakh 88,880 rupees, right? The Ethereum value or the exchange rate has increased because now what happens? The number of Ethereum in that pool is decreasing, supply is decreasing. That's why the price will increase. That is the rule. So that's why the constant product mechanism is has to remain same. So somebody has to deposit 3,88,888 RINR to take one Ethereum out. But still you make profit, right? Because once you deposit that and take one Ethereum and in Binance you sell it as 4 lakhs, you'll get an within few seconds or few minutes, you'll get an profit of 11,000, right? So that is the profit of the trader. And that is how they use this liquidity pool. You can take this and give loan to somebody else, right? So there are a lot of applications of that, right? You can take money of this and give in to loan in some other exchanges also, and that is how those cryptocurrency trader work. Is this part clear or any doubt?
So, one more question. So,
Yeah.
so in Binance, at initial, we are taking the 4 lakh amount, right? The trader is buying that amount earlier, right?
Buying means
Buying means, you said that 11,111, he's just getting profit instantly. So that is the amount he is buying earlier, or that is the fixed price of the market?
no, there is no fixed price, right? So this is a separate exchange. This is Uniswap exchange. This is a Binance exchange, right? So I was giving in hypothetical situation, right? Let's say in this exchange the rate is low, Ethereum is low. Obviously it won't be that much difference, 50,000 difference. Let's say in a particular day when you open in the evening, In Uniswap, the Ethereum rate is 3,50,000. In another exchange, the rate is 4 lakh. So what you will do, if you have RINR currency, you will deposit here in Uniswap. You will take one Ethereum, you will sell it at Binance, because in Binance the price is 4 lakhs. It might drop again too, because once in Binance the Ethereum supply increases, there also will the price will drop. Right. By the time you sell it, it might have become 3,95,000. Right. So that's why this arbitrage opportunity will be in the few seconds, and obviously it won't be that big difference of 50,000. So to answer your question, in Binance is a separate exchange. Like there are different exchanges, Wajirex, CoinDCX. Lot of exchanges are happening, right? If you open currently what is the Ethereum price, you look into different exchanges, right? Manually, if you look into different exchanges and see the Ethereum price is difference, you will buy Ethereum from some exchange and sell it here. So that is the arbitrage opportunity you will take.
Okay, sir. Okay.
Okay. So now the next part is, so this is how the decentralized exchanges or liquidity pool work. So I think Uniswap was one of the biggest liquidity pool that's got the decentralized exchanges. There are somebody like some more decentralized exchanges like Balancer, but they work in different mechanisms, right? So this is the constant product mechanism where the multiplication of number of cryptocurrencies in that liquidity pool need to remain constant. Okay. Now, what is the challenge happens at this particular moment, at that particular second, if I look into what is the market price of total this liquidity pool value, right? So I have 10 Ethereum, right? And in market, it is going around 4 lakhs, right? So that means around 40 lakhs of total value of Ethereum. And how much? 3 lakh 35 lakhs, right? So RANR is a kind of a stable coin, hypothetical stable coin, which is value will remain always close to rupees, Indian rupees, right? So at this moment, when I look into the market, the total Ethereum value is, because I know that in market people are paying 40 lakhs, sorry, 4 lakhs for one Ethereum. So total Ethereum value in this liquidity pool is 40 lakhs. And obviously I have RINR, that is a stable rupees currency. So that is around 35 lakhs. So the value is around 75 lakhs, right? After this thing has happened, somebody has given Ethereum, one Ethereum, and sorry, somebody has taken one Ethereum and deposited some RINR, right? Now what is the situation? In this liquidity pool, current situation is I have 9 Ethereum and this much 38 lakhs, whatever RANR is there in this liquidity. So what will be the value right now? So this is anyhow. So now if I look at the total value, okay. So few seconds back, few minutes back, I have 10 Ethereum in the liquidity pool and this much rupees RANR, right? 35 lakhs RANR. So total value of the liquidity pool was around 75 lakhs within like let's say it is the 0 second, like, or the t1 second, right? Then after t1 plus 5 minutes, what has happened? Somebody has put one Ethereum, sorry, somebody has taken one Ethereum and deposited RINR. What is my total value right now? If let's say same in Binance still it is trading at 4 lakhs rupees, right? So I have 9 Ethereum, that is 36 lakhs, and I have this 38 lakhs, whatever the amount of money. So what happens right now? I total valuation is how much? 74 lakhs 88,889 rupees, right? So whatever that arbitrage opportunity that trader actually got due to this variation, That is the decrease in value here. So now what is my decrease in value? 7,50,000 minus same thing, whatever that minus 11,000, that is actually will be negative, right? Minus 11,111, right? 5 minutes back, I have 75 lakhs. Within 5 minutes, the value of that liquidity pool has decreased by 11,100 rupees, right? So this is something known as impermanent loss. This loss is not permanent. This loss keeps fluctuating. Sometimes it will increase, sometimes it will decrease, sometimes you will be in profit, sometimes you will be in loss. Think about as a liquidity pool provider. Let's say I had created that liquidity pool. In my account, so let's say I had 10 Ethereum and this 35 plus RINR. Rather than keeping in my wallet, I thought, okay, no, I will use it in a decentralized exchanges, right? So I created that liquidity pool. But if I had not used that, I had kept with my in my wallet, then the valuation still would have been remain same 75 lakhs. But because I used that in my decentralized exchange as a liquidity pool, the value has now come down to 74 lakhs 88,000, which is a temporary loss of 11,000. Right? Think about your stock exchange, right? These fluctuations keeps happening, right? Depending upon the trading activity, you have not traded anything, right? But people keep trading, your valuation keeps increasing and decreasing, right? Same situation here, because somebody took that arbitrage opportunity, right? Took ethereum from your liquidity pool and sold it in some other exchange. Now what happens, the valuation of your liquidity pool has decreased temporarily. So this is known as a impermanent loss. Permanent loss means which you cannot recover. This is something known as impermanent loss, because you know that after some time somebody will deposit Ethereum and take it out INR, right? Whenever INR value increases or Ethereum value decreases, right? So in that case, again your liquidity pool will be in the 50-50 ratio, right? So I was just giving that example of 11,000, though that big difference doesn't come. It will be in few dollars or hundreds of rupees, right? But again, depending upon the number of quantity, total value of money, you can make a lot of profit. But this is known as impermanent loss. For a particular period of time, your total value of liquidity pool might decrease, right? The amount by which it gets decreased temporarily is known as impermanent loss. Is this concept clear? Any doubt on this?
Sir,
Yes.
I just want to know about this impermanent loss. Is there any way to mitigate it? Like, if everyone,
Yes. So there is no way to mitigate this. Now the question is, if I'm making a temporary loss, why should I make that, right? Why should I should have kept in my wallet, right? Why should I give my money to liquidity pool? If it was in my crypto wallet in certain exchanges, the valuation would have been remained same 75 lakhs. Why, if I am keeping it this liquidity pool, suddenly for a few minutes or few seconds, the value is getting decreased till it is again the Ethereum number of Ethereums comes back to whatever number 10 or whatever the original number, right? So there is no way to mitigate that. This will keep happening because market fluctuations will keep happening. But now the challenge is, why should I keep my money there in decentralized exchange? The thing is that in Uniswap, again, Curve and Balancer have a different transaction fee. For any time any this kind of monetary transaction happens, they charge those traders around 0.3 percentage. So this is the, at least at present they are charging around 0.3 percentage of trading fee. So what happens, whatever the trading fee, how much trading they did, around 3,88,000. So like how much, 116 or 100 whatever 20 rupees. So whoever trades, right? These trades keeps happening in per day, thousands of trades, or even not thousand, hundreds or 50 trades will be happening in your liquidity pool. Per trade, they are charging 0.3 percentage. So in this particular person, when they make that trade, is giving that money to Uniswap as a 0.3 percentage of that trading rate of 116 rupees. So that actually Uniswap doesn't keep. That money is transferred to the liquidity pool, whoever has provided that liquidity pool. Let's say I am the owner of that liquidity pool. It doesn't happen that only single owner will be there. There will be many people like me who would have contributed to that liquidity pool. It will be equally distributed. Per day basis, let's say total transaction fee of 1 lakh or 10 lakh of transaction fee happened. Let's say there are 10 owners. So per person, 1 lakh of transaction fee will be sent, right? So this is the actual money which you are getting. By keeping this liquidity pool alive, by keeping this liquidity pool active, you are getting that. Let's say if I was the only owner of that liquidity pool, by the end of the day, let's say like these 50 transactions happened, right? 50 multiplied by 116, whatever 6,000 or 7,000 rupees I would have earned. So it is a continuous earning for me, right? Every day I'll be earning whatever transaction fee people are using my liquidity pool. That means they have to give me a transaction fee. So they basically give it to Uniswap, and Uniswap will be distributing. If there are multiple owner of that liquidity pool, so that money will be equally distributed, right? So that is also to answer your question whether there is anything to mitigate. No, because market fluctuations happen and your value of that liquidity pool keep changing. But yes, people still invest in that because they get money back in that transaction fee, which is a continuous income. Because you know that cryptocurrency value will keep increasing and decreasing. That is not in your control. But now you can use that changes if you do not have time or you do not have kind of effort want to put on arbitrage. Because again, for arbitrage also you need to have a lot of effort. You need to look into different exchanges, or you have to have that kind of software which can automatically look into that kind of exchanges and take these arbitrage opportunities, right? Simply I just put in the liquidity pool and I get that transaction fee is my kind of return, right? So that is how it works. Any questions, any other questions on this? Okay, so that is what we are discussing in our last session. Just a moment. So this again, like I said, this is just only one example of a decentralized exchange, Uniswap. Then there are others also. They have different mechanisms, but again, the like kind of point is there is no third party who is managing, or large organization who is managing a order book. It is automatically managed. So this is the impermanent loss which I just discussed. So this is again a temporary loss. So how kind of why should I then invest if even if it is temporary? I'm making a loss, right? If it was in my wallet, then the value would have been more, right? So that's what I was talking about. Uniswap basically charges 0.3 percentage on every trade. So let's say per day 10 trades or 15 trades happen. Whatever the trade value happened, let's say 10 lakh or 5 lakh of trading activity happened on that 0.3 percentage, right? That actually directly given to the liquidity pool owners, right? If I was the single owner, whatever the trading activities happened, right, 0.3 percentage of that will come to me. Then again, the other exchanges have that different. So I think Uniswap has the highest trading fee. That's most of the people who want to invest, right, invest there. Per balancer, I think they have a very low transaction, 0.001 percentage, right? So which is not actually beneficial for a investor. So the last slide is decentralized insurance. Whenever you are talking about finance, right, obviously somebody has to be there to insure those financial products. Let's say I have put money in exchanges, or I have put money in this liquidity pool. Somebody hacked that, or that exchange person gone missing, right? And it happens, it keeps happening. Lot of centralized exchanges, people open in, I think Poland or somewhere. I think they took around 3 billion of rupees worth of cryptocurrencies was stolen. One thing is that hacking. Second is that that exchange might get closed. There are a lot of issues with cryptocurrencies also, right? Because the regulations are not there. So in that case, who is going to secure my money, right? So then next part is whenever any financial instrument will be there, obviously there will be use cases of insurances, right? So there are different kind of DeFi insurances, decentralized finance insurances, crypto wallet insurance. Let's say I have a hardware wallet or a software wallet. I have kept money. Somebody hacked it or I lost it. I can insure that. Collateral protection for crypto-backed loans, right? If I want to take certain loans, right? Or I want to give certain loans and that loans get defaulted. Somebody took loan and they did not return it. Like most of the banks have this non-performing asset, but banks are kind of regulated, right? So they can take legal action. But here, nobody knows, nobody else, right? Somebody takes loan and I have given this. Let's say in this case, I have provided loan to somebody else in this crypto exchanges, and they do not return, right? Forget about the interest, they do not return the principal also, right? In that case, that again, like same case in your banking, home loans or any kind of vehicle loans are insured. Same thing in your DeFi loans can be also insured. Smart contract cover, because all these things are happening in a algorithm, right? There is a chance that algorithm, there is bugs, right? Algorithm did not work properly. You provided all the documents, but there is a fault in algorithm, or there is a problem with that algorithm. There is a problem with the code for which it did not work, right? And you lost certain amount of money, right? For that also, companies are providing cover. Cryptocurrency insurance, again, there are two types. You have a wallet insurance, or you can have a insurance on the currency fluctuations, like this kind of liquidity pool fluctuations. If somehow it becomes permanent, right? So that's why these exchanges, what they do, these decentralized exchanges, do not keep two volatile cryptocurrencies with each other, right? So I generally won't take a Ethereum and a Dogecoin or a Shiba coin, because that keeps fluctuating. Suddenly, Shiba coin rate gets zero. I have lot of Shiba coins on that wallet, and nobody want to take that, right? So it will be pure loss. So what they do generally, basically, let's say if I'm taking Ethereum as one cryptocurrency, other cryptocurrency will be stable coin. So if you remember, we discussed something called a stable coin, which is basically pegged to, which is value is pegged to a, or backed by a asset in real world. Might be United States dollar, or a Indian rupees, or a euro, or gold, right? So you know that that value won't fluctuate that much. So you have certain belief on that. You have certain faith on that currency, right? Then mutual to replace insurance, right? So that is basically kind of both a combination of, like in our case, of certain mutual fund, insurance come mutual fund, right? So that concept, this last part till it is not applied a lot, but the first four parts have been huge cases. Companies like this, and some of the examples are Nexus Mutual, Etherix. So Etherix, if you have a, let's say, ledger or a any kind of hardware wallet you have, right? You can take a insurance cover from Etherix. So basically, whatever cryptocurrency you have in your wallet, that can be insured for a certain amount of cryptocurrencies. Then, if you are lending money in certain crypto exchanges, right, or you have a liquidity pool provider, you can take a help of, or you can take insurance from Nexus Mutual. I think CTX also provides same kind of liquidity pool insurances, or loan insurances, right? So this is how basically, wherever you have to talk about finance, right? Next step is insurance. Can you insure those financial products, right? So there are like many use cases happening, or people have started creating on decentralized finance insurances. Any questions on this?